Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Fwd Group Holdings Limited Annual Report. Fwd Group Holdings Limited offers a diverse range of insurance products and services globally. At the core of their business are life insurance policies that cater to various customer needs. In addition to life insurance, they also provide accident and health insurance coverage, ensuring customers' well-being in times of need. Their product portfolio extends beyond insurance, with savings plans designed to help individuals achieve long-term financial goals. Furthermore, Fwd Group Holdings Limited distributes related investment and other financial service products, providing customers with a one-stop solution for their financial needs. With its international presence and commitment to customer satisfaction, the company has established itself as a reputable player in the global insurance market. Fwd Group Holdings Limited market capitalization of $43 billion is materially smaller than most of its industry peers, of roughly $307 billion. Fwd Group Holdings Limited trades at a lower price-to-book ratio of 0.63 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 87% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth in the insurance industry can be attributed to several key factors. New business sales, also known as annual premium equivalent (APE, play a significant role in driving revenue growth. This is followed by incremental premiums from existing contracts, investment income, and reinsurance solutions. Additionally, the accumulation of experience data for risk evaluation and pricing enables insurers to make informed decisions, leading to increased revenue. On the other hand, revenue decline can be attributed to several factors. Early surrender of policies results in a loss of premium income, while losses on onerous contracts further exacerbate this issue. A decrease in reinsurance premiums ceded also contributes to revenue decline, as does an increase in claims and other insurance service expenses. Geographical diversification is another crucial factor that affects revenue growth or decline. Regions such as Hong Kong and Macau have experienced significant growth, with a 38% increase in total written premium, income, TWPI, and 37% increase in first-year premiums. In contrast, regions like Thailand and Cambodia have seen a decline in single premiums by 35%. Emerging markets, however, have shown promising growth, with a 27% increase in TWPI and 40% increase in first-year premiums. Product diversification is also an essential aspect of revenue growth. Insurers that offer a range of products, such as life insurance sales, group insurance contracts, and telecommunication services to related companies, tend to experience higher revenue growth. Net income experienced a significant change from 2024 to 2025, with an increase of 18%. This growth was substantial enough to reach a record high of $166 million in 2025. However, it's worth noting that no previous year's figure is provided for comparison. The profit margins also underwent a notable transformation during this period. The lower rate environment had a significant impact on the company's profitability. Nevertheless, the contractual service margin balance strengthened by 18% in 2025, contributing to an overall improvement in profit margins. Regional variations played a crucial role in shaping the company's financial performance. While some regions such as Hong Kong and Macau saw a notable increase of plus 15.6% in operating profit after tax. Others like Thailand and Cambodia experienced a decline of minus 2.7%. Japan and emerging markets and others also reported modest growth and significant losses respectively. The improvement in profit margins can be attributed to several factors, including increasing profitability, reduced leverage, operational efficiency gains, AI-powered tools, and accelerated software development. These strategic initiatives have undoubtedly contributed to the company's financial success. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the latest available data, the company has achieved a significant milestone in terms of operating cash flow. In 2025, the net cash provided by operating activities reached $247, marking a positive trend for the company. This positive operating cash flow is a crucial indicator of a company's financial health and stability. It suggests that the company is able to generate sufficient cash from its daily operations to meet its financial obligations and invest in growth initiatives. The fact that the company has achieved this milestone in 2025 is a testament to its efficient management practices and ability to optimize its resources. Overall, the positive operating cash flow generated by the company in 2025 is a significant achievement that bodes well for its future prospects. It demonstrates the company's ability to manage its finances effectively and generate value for its stakeholders. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, it seemed that the debt level had decreased from 25.5% in December 2024 to 21.3% in December 2025, page 11. However, a closer look at other pages reveals that total debt has actually increased significantly, with various metrics showing growth. $2,793 million to $3,046 million, pages 19 and 159. $1,797 million to $2,055 million, page 30, and $43.669 million to $52.196 million, page 58. This increase in debt level is also reflected in the total liabilities, which rose by $8,588 million, page 21. In terms of interest expenses, there are mixed signals. On one hand, refinancing of debt resulted in a reduction of approximately $72 million annually, page 11, and interest expenses related to derivative financial instruments decreased from $528 million to $490 million, page 19. However, other metrics show an increase. Finance costs related to borrowings and long-term payables rose from $227 m to $244 m, page 17, and interest expenses paid on borrowings increased by 3%, page 63. Overall, the data suggests that while there have been some decreases in interest expenses, the increases are more pronounced, indicating a general trend of rising interest expenses. The performance of various segments and regions in the industry has been mixed. On a positive note, Hong Kong and Macau have shown significant growth, with an increase in OPAT by 24% and APE growth rates ranging from 43.7% to 58.4%. Japan's FWD Life also performed well, despite some challenges due to capital regulations. In contrast, Thailand and Cambodia experienced a decline in performance, with a decrease in VNB growth of 18.5% and APE growth of minus 6.5%. Emerging markets as a whole have been inconsistent, contributing to an increase in OPAT, but also experiencing a decline in value. Japan's FWD Life has struggled due to regulatory changes, further highlighting the challenges faced by this region. Management is committed to delivering attractive risk-adjusted returns through responsible investing and strategic partnerships. The company remains focused on executing its strategy in high-growth Asian markets with a customer-centric approach, prioritizing technology investments and building talent for future success. To capture Asia's significant protection gap, FWD aims to strengthen leadership in the region and accelerate digital transformation. This includes scaling direct and other channels, such as digital commerce, through automated underwriting, e-submissions, and digitalized customer management support. The company is also committed to innovation, expansion into new markets, and strengthening its health ecosystem through partnerships and innovative solutions. Management is prioritizing customer centricity, investing in technology, and building talent to drive growth and deliver superior risk-adjusted returns. In terms of distribution channels, the brokerage/IFA channel has shown significant growth, with a 51% increase in APE to $895 million in 2025. To further optimize this channel, management is strengthening partnerships through dedicated relationship management teams. Overall, FWD's strategy focuses on delivering sustainable, long-term returns within its risk appetite, prioritizing capital preservation and unlocking a liquidity premium in private markets. The company continues to be customer-led, accelerating digital transformation, deepening customer relationships, and setting new benchmarks for innovation and service excellence. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the company has expanded its influence through associates, acquired groups of contracts, and taken a minority stake in a related company. Additionally, it has invested in debt securities under fair value through other comprehensive income, FVOCI, and loans and deposits under amortized cost. The company's divestitures have been focused on reducing its holdings in debt securities under FVOCI and loans and deposits under amortized cost. Specifically, it has sold off 13,577 debt securities in 2025 and 9199 in 2024, as well as 309 loans and deposits in 2025 and 459 in 2024. These acquisitions and divestitures demonstrate the company's strategic efforts to manage its investments and optimize its financial position. By expanding its influence through associates and acquiring new contracts, the company is positioning itself for future growth. At the same time, it is carefully managing its debt securities and loans to minimize risk and maximize returns. The company has a history of paying dividends to its shareholders. This practice is reflected in various sections of the report, including page 68, which highlights participation rates for dividend payments across different locations. Furthermore, on page 92, it is stated that dividends are recognized when declared and authorized, indicating a commitment to regular payouts. The company's stance on dividends is explicitly confirmed on page 97, where it is clearly marked as yes. This suggests a deliberate decision to distribute profits to shareholders through dividend payments. Additionally, the report mentions dividends received from other companies on page 121, demonstrating the company's involvement in dividend transactions. As of December 31, 2025, the dividend amount was $10, as stated on page 122. This figure provides a tangible representation of the company's commitment to rewarding its shareholders through regular dividend payments. Overall, the evidence presented in the report confirms that the company has indeed paid dividends and continues to prioritize shareholder returns. That concludes the financial summary for Fwd Group Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.